Have you ever wondered how big-time investors just know where to put their money? Well, I'll let you in on a secret. It's not some kind of magic. A lot of the time, it just comes down to a few simple, powerful formulas that let you see right through a company's finances. And today, we're going to hand you that exact toolkit.
So, let's put you in the hot seat. Imagine you've got a chance to buy into a company, but you've heard whispers that its future is a little uncertain. Your own money is on the line? How in the world do you make the right call? Well, stick around because that's the exact question we're tackling.
All right, so let's meet our company for today. We're going to call it DA. Now, potential investors are circling DA, but they're all asking the same thing. Is this company a rocket ship about to take off, or is it a sinking ship?
Now, to solve a puzzle like this, you can't just go with your gut feeling. Nope, you need the right tools for the job. And for an investor, that toolkit is a set of things called financial ratios. Think of them like an X-ray, letting you see what's really going on inside the business.
Okay, so it's time to open up that toolkit. We are going to decode DA's financial health using the very same numbers that the pros on Wall Street use to make billion-dollar decisions.
I want you to think of these formulas like a doctor's chart for a business. Seriously, each one is a specific test. You're checking the company's pulse, its blood pressure, its reflexes. You get the idea. It tells you exactly where the company is strong and, maybe more importantly, where it might be sick.
Now, these tools fall into four main groups. First, profitability. Is the company actually making any money? Then gearing, which is just a fancy word for how much debt it's in. Liquidity checks if it can, pay its bills on time. And finally, investment ratios. These tell us what kind of return we, as investors, might get. And since our big question today is, should we invest? Well, it makes sense to zoom right in on that last category, right?
All right, enough talk. Theory's over. It's time to actually do the math. We're going to take two key investment ratios and apply them directly to company DA. Let's see what story the numbers have to tell.
First up, dividend yield. Okay, so what is that? Well, dividends are basically just a little thank you payment. It's a slice of the company's profits that they pay out to people who own their stock. The yield tells you your annual return on those payments, kind of like the interest rate you'd get on a savings account. For anyone looking to get a steady income from their stocks, this number is absolutely crucial.
And the formula for it? Super simple. You just take the dividend paid for each share, divide it by the price of one share, and then multiply by 100 to get a nice, clean percentage.
Let's plug in the numbers for DAF. First, we need the dividend per share. The company paid out $1.1 million across 10 million shares, so that gives us 11 cents a share. Easy enough. Then, we take that 11 cents divided by the share price of $5 and multiply by 100. And there's our answer, a dividend yield of 2.2%.
Okay, tool number 2 is the price-to-earnings ratio, or PE ratio. Now this one is all about the vibe. It tells you how confident the market is about a company. It compares the stock price to how much profit the company makes per share. So in short, it tells us how much investors are willing to pay today for every single dollar of profit the company is making right now.
And believe it or not, the math for this one is even easier. It's just the share price divided by the earnings per share. That's it.
So let's crunch the numbers for DA one more time. The company made $6 million in profit, and there are 10 million shares out there. So the earnings per share is 60 cents. We take the $5 share price divided by that 60 cents, and we get a PE ratio of 8.3.
Okay, we've got our numbers. A dividend yield of 2.2% and a PE of 8.3. But listen up, because this is the most important part of the whole process. Numbers on their own are totally meaningless. Now we have to figure out what they're actually telling us about whether or not we should invest.
So, let's start with that dividend yield. Last year, it was 1.43%. This year, it's 2.2%. Hey, it went up. On the surface, that looks like fantastic news, doesn't it? A better return?
But hold on a second. We have to ask why it went up. And here's the twist. The yield only increased because the company's share price fell. Oof, that's not a great sign. On top of that, even at 2.2%, that return is way below the average for this industry. So what that really means is you could probably get a better income from a different investment.
Okay, now let's look at that PE ratio. Last year, it was at 10. This year, as we calculated, it's dropped to 8.3. So what's the story here?
Well, a drop like this suggests the market, all those investors out there, is getting nervous. They're losing confidence in DA's ability to make profits down the road.
Remember, the PE ratio is all about optimism, and right now, that optimism is fading. When you pair that with the fact that profits have already gone down, well, DA is starting to look a lot less attractive.
So, we've run the numbers. We've dug into the story behind them. We have our evidence. Now it's time to put on our analyst hat and make the call. Should we, or should we not, buy shares in company DA?
So where does this leave us? You can see it's not a simple yes or no. In the pro column, the dividend payments are super secure. That cover of 5.45 means the company earns more than 5 times what it needs to pay them out. That's great. It also has some big expansion plans and not a lot of debt, which is a good thing. But then you look at the con column, a falling share price, a below-average dividend yield, and that PE ratio, which is screaming declining confidence.
And this brings us to a really crucial piece of wisdom, and this comes straight from our source material. Looking at just 1 year of data is only a snapshot. To make a really smart decision, you need to look at the trends over a much longer period.
So, what's the final verdict? Well, the truth is, it depends entirely on what kind of investor you are. If you're a cautious person who needs income right now, that falling share price and low yield are probably giant red flags. You might want to look somewhere else. But if you're a long-term investor, someone willing to take a bit of a risk on those expansion plans, you might see this as a chance to buy in cheap. The most important point here is that there's no single right answer for everyone.
So there you have it. You now have the basic toolkit to look under the hood of pretty much any public company out there. You know how to calculate these key ratios and, more importantly, how to start reading the story that the numbers are trying to tell you. So the next time you see a company making headlines, you'll know exactly where to begin your own investigation.